e.g. internal market. I'm grateful that Maarten doesn't come from that particular Directorate General, whom I shall refer to as the hooligans. Remember, these are the people that brought you the Bolkestein Directive for juridical chaos throughout Europe and union busting. So the crises also highlight, this is from the Liikanen report, which is, I'm sure Maarten understands better than I do, on the banking union. The crises, say Liikanen, also highlighted the danger of putting market integration first and building policy integration later. That not only describes the financial situation, it essentially encapsulates the history of the European Union since about 1983. Okay, what did we have first prior to the crisis? This is the boom years. What was going on in the boom years? We had what was finance was seen as key in the Lisbon Strategy. The Lisbon Strategy was a kind of moral panic that absorbed European leaders that America was about to overtake us, and therefore we had to Americanize, well, our societies, but our financial systems first. And we have, sorry about this, so from the Stockholm Council, business and citizens in the European Union need a regulatory environment which is clear, effective and workable in a rapidly changing global market. This is a key element if the European Union has become the cheapest and easiest place to do business in the world. It's only subsequently they learned that cheap business is not always good business. Alexander Lamfalussy was brought in to rescue the financial integration program, which was in chaos. He produced a report, and largely that report rescued the financial integration program. Some of his report was neglected. In the report, the draft report submitted by Alexander Lamfalussy, who is not a Trotskyist, you know, he's a former head of the Bank for International Settlements. Greater efficiency, he said, does not necessarily, this reminds me of what Maarten was saying a few minutes ago, but Lamfalussy had saying it more than 10 years ago. Greater efficiency does not necessarily go hand in hand with enhanced stability. Increased integration of securities markets entails more interconnection between financial intermediaries on a cross-border basis, increasing their exposure to common shocks. There is an urgent need to strengthen cooperation at the European level between financial market. He wrote this in 2002. And the institutions in charge of macroprudential regulation. What was the response? It was politely but firmly suggested that we drop the subject. That's what the hooligans said. They said, what were the hooligans actually interested in? Well, what they were interested in was establishing a subprime mortgage market in the European Union. That was their big project. They weren't worried about stability. On the Green Paper in August 2005, many expressed the view that the further integration of the EU mortgage market, sorry about that, I don't know how to get that, could be considerably enhanced by the emergence of a pan-European funding market. Yeah? What the Commission did at that time, what I hope they're going to stop doing, is if they want a policy justified, they go on the market and they hire economists to tell them it's a good policy. The people they hired in this case were London economics. You know. The trouble with buying research is that the customer will probably get what he wants. And they have to stop this because it's a democratic monstrosity not to consult experts on an impartial basis. But anyway, what the London economics people who were only doing what they were told and what they were paid to do, they said, US experience, this is our model. This is where we want to be. We want to be the US dynamic economy, entrepreneurs, venture capital, lots of security trading. That's where we need to be. Legal or other restrictions to banks' geographical expansion to reduce the efficiency of the mortgage lending industry. Steps to create a single EU mortgage market would increase incentives. Removing restrictions on maximum mortgage interest rates would allow a subprime mortgage market to grow. There you have it. That was their policy. Alexander Lamfalussy says stability is to forget stability. what we need is subprime. Yeah? Now, actually, they didn't get subprime. Why? Because before the white paper came out, the US market blew up. So this is what they said when the white paper came out. Oh, it's a retreat. You try and find mortgages on the Commission website. You know, I think you take about 100 clicks to get hold of mortgages. Recent events in global mortgage markets have confirmed the pertinence of the approach proposed. That's the blackest lie I've come across in my professional career. What it did was it completely refuted the approach that they had adopted, and therefore they abandoned that approach. Went right there, of course, but there you go. So, then, leveraging Europe. This is the hooligans DG whatever press release as of February 2008. European banks are well capitalized. I don't think Maarten said that. The origin of the current financial turmoil came from the US subprime, not us. And a large portion of the European financial sector is not directly affected. Where financial institutions have sizable direct exposures to the US subprime market, or indirect exposures, the affected entities have well-diversified portfolios and large capital buffers. So say the hooligans. What is the reality? The most shocking, this is Wolfgang Munchau, the most shocking news from last week's excellent Global Financial Stability Report was not the headline estimate of bad assets. Much more shocking was that the lion's share of these assets belong to European, not North American banks. Of the total 4 trillion, the global banking system accounts for 3 trillion. Of that, a little over half is sitting in European banks, or US banks account for only 1 trillion. You get the picture. All these data tell us that Europe is both the biggest problem and has made the least progress. So this is the reality. This is not something that is due to national supervision or the fragmentation. This is something which is largely due to a gung-ho, breakneck, reckless, deregulatory integration drive. Yeah. So now the people who brought you this are saying Europe is the solution. Well, I hope Europe will find a solution, but it's not by any means guaranteed. That was the build-up to the crisis. Now quickly look at the responsibility of the European leaders in the crisis. Okay, I'm only following now a very cogent book by Elliott and Brandt calling for a New Deal for Europe. There are 3 main policy failures. Firstly, banking has not been cleared up. There was no determination by the member states to clear up the banking system. Now, what you have is, Elliott takes 2 models, I haven't got time to go. The Japanese model, do nothing, don't resolve the situation, let zombie banks and banks with impaired balance sheets hang around forever and have stagnation. Alternatively, Nordic model, early 90s, completely clear and purge the banking system, get the economy moving again. Yeah? What we have in Europe so far, I hope Maarten can help to move us towards the other, but what we have so far is a Japanese approach. Failure to isolate the Greek crisis. The case of Greek public finance should have been kept specific. Yeah? If they had, it would not have been expensive. Relatively, this is quite a small country with quite low levels of income. It would not have been expensive to have isolated the Greek situation. If Italy goes haywire, then it will cost an absolute bomb. The failure to isolate the Irish and Greek cases. And finally, fiscal adjustments too fast. This drive, this already by 2009, the institution which Maarten represents was calling for an end to fiscal support, an end to expansionary fiscal policy to deal with the situation, and a return to normality for fiscal consolidation, get back to the Stability Pact numbers, etc. Already in 2009 they were demanding this, yeah? And they've pushed that through in all the countries. So what is to be done? I agree a large part of what Maarten says is to be done, but it follows from the first question, who is responsible, that it is a European responsibility to clear up this mess. Yeah. It is not the responsibility of the Irish and the Greeks to deal with this chaos. They cannot do it anyway. They don't have the power, they don't have the resources. Now, the debtor's prison, we used to have 18th century, we had debtors' prisons in England, and they're a much better idea. This modern nonsense of insolvency, where you wipe out someone's debts and let them resume economic activity, is obviously absurd. What we need is a debtors' prison. And the Memorandum of Understanding, that was signed in the spring of last year by Greece, is a totalitarian document. There's absolutely no doubt about that. This is one thing they require. Reduction. This is before a penny is to be spent. Reduction in pharmaceutical expenditure by at least 1,076 million. How did they get that 76? What kind of by reducing medicine prices, generics and branded medicines, increasing co-payments, reducing pharmacists' trade margins, application of compulsory e-prescription. What are they talking about? I suggest a new concept that's absolutely unheard of, but will revolutionise European integration. I propose a concept of subsidiarity, that the functioning of Greek chemist shops is a question for the Greeks. Even if they're insolvent, it's still a question for the Greeks. So there's another one. Reduction in the number of deputy mayors and associated staff. Reduction in central government's operational expenditure, election-related spending. Funding cuts to subsidies to residents in remote areas. They're telling, look, Greek local government is an issue for the Greeks, and even if Greece is insolvent, Greek local government is still an issue for the Greeks. Macroeconomic constraints and so on in negotiations, okay, but this is nonsense. Okay. Now I'm coming on now to what is to be done, but it seems to me banking union is both crisis management and long-term institutional construction. I think the most important aspect of it is crisis management. We need a banking union to get us out of this mess. Yeah? Okay, it was nice. My analogy was this. You know, we say in England, after the horse has escaped, you lock the stable door very carefully. And I think it's nice to have a good stable door with nice lock and everything, but we need to get the horse back, you know, because we've lost our horse. And so this, I would say the priority here has got to be, has got to be to resolve the crisis, and the banking union is necessary for that crisis. And that's being resisted. It's being resisted in Northern Europe. And no longer being resisted by the Commission. I have to say that because there's more joy in heaven over one sinner that repenteth, etc. This is Schäuble. Augustine's prayer, God give me chastity, but not quite now. Yeah. So we'll have a banking union. We'll have two banking unions. The first one will be wood. Only the second one will be steel. The first one will be wood, which means that in the little Greek compartment of their wooden house, the Greeks will deal with their banks. And the Irish will actually, the Irish need to be, you need to indemnify the Irish government for the mess of the Irish banks, because the ECB already pushed the Irish into an absurd rescue operation which they couldn't afford. And when they couldn't afford it, they put them in the debtors' prison. The Irish are in the debtors' prison too. They've been told how many spoonfuls of sugar must go into the tea of the deputy mayor in Ballymena. So there will be taxpayer involvement. I know it's nice not to have taxpayer involvement. There already has been a massive amount of taxpayer involvement. Taxpayer involvement is completely unavoidable. You know? Are we moving to resolution of all costs borne by creditors and shareholders? That would be lovely. It would be lovely if we could have it. No. This is England, where we help the banks. Those are the fat cats getting the blood transfusion from the little people. It's undesirable, but I think it's going to happen. The Germans bought bad assets or dubious assets to the tune of 11% of of GDP to rescue German banks. That's they're all part of the wooden house. The taxpayer was involved, but because it's a wooden house, we don't have any connections between the different bedrooms. Okay. The banking situation is still not particularly happy. This is from the IMF Stability Report. The two indicators are leverage. As you move along this way, the leverage is declining. So it is declining, but pretty slowly. And in fact, the non-peripheral banks have made less progress than the peripheral ones in reducing their leverage, probably because they haven't had a complete collapse in their assets. That needs to be changed. I don't think we can do so probably without taxpayer involvement. Some banks in the euro area periphery remain, this is the IMF again, challenged by delivering pressure, still elevated funding costs, deteriorating asset quality and weak profits. This has to be dealt with. If you want an economy that's functioning, this will have to be done with. Now, Munchau, I'm just going to summarise how I think the banking union, I agree with Maarten, but I think that the second term here is extremely important. A banking union that functions as crisis management, that gets us out of this mess, has to be comprehensive, it has to be retrospective. That is to say, we have to look at the bad assets which exist, which are already poisoning the situation. It's nice to have a system which will prevent banks acquiring so many bad assets in the future, but the fact of the matter is they have an awful lot of them today. A banking union which is not retrospective won't work. I'm amused when you say that regulatory capture is a problem for national governments in Europe. On the contrary, the European Union as such is a massive example of regulatory capture. We have corporations writing the laws, paragraph after paragraph, coming from the industrial lobbies and not being changed by one comma before they become directives. So, and actually, there is strong democratic defences against the corporate lobbies at national level, which don't exist in Brussels. This town is riddled with lobbyists, writing our laws, providing expertise to the Commission on issue after issue. So I don't buy that. I really can't buy that. Gradually, banks are reducing it. What's happening to the banks at the moment? Big banks. They're being recapitalised by their customers. How can they do that? Because the central banks are lending to them at zero interest rates. And they're not offering their customers zero interest rates. And their spreads are quite wide, quite nice spreads on banking operations at the moment. That's what's happening. So taxpayer involvement is happening every day. The involvement of the citizens in recapitalising these institutions. I don't know about banking structure. I'm pretty agnostic about it. I don't believe the two mantras. Goodhart calls these the two. If it's too big to fail, it's too big. What's too big? If it's a Cypriot bank, it's too big. If it's a German one, it's probably okay. Or we must separate the public utility from the casino. I don't buy this too. How this Chinese wall between cheap money in the commercial banks and the traders' need for transaction balances, how this is to be maintained. I wouldn't take that approach. I think there is a strong consensus, that's all I'll say about this. I have a very strong consensus that we need much lower leverage ratios, and I think those are attainable. I think Motti and Helwig make a very good case, and it's a widely accepted case for substantial reduction in leverage. My priorities would be that stronger capitalisation and also strong defence of the retail investors. The record of the European Commission on protecting retail investors in finance is a disgrace. And they were pressing for more deregulation throughout the first decade of the century. And financial institutions and institutional investors have been fleecing their customers on the most disgraceful scale. So I would say stronger capitalisation and defend the retail investor. I would not have a strong view on markets versus classical banking intermediation and structural things, and I don't think those structural issues are so important. I'll end with one. I'm sorry about this, Maarten, but that financial transaction tax, as devised and drawn up by the Commission, is imbecilic. It just does not make sense from start to go. And it's been put to appease people like yourselves, I suppose, progressive people on the left who've been looking to try and put some pressure on the banking system, but this will not do it. And I want to ask you, this is a technical issue, but they're going to tax repurchase agreements, but they're not going to tax FX swaps, and the two things are perfect substitutes, which means that they're telling the European banks they've got to go to FX swaps. In other words, for security, don't put up European paper or European documents for collateral, put up American dollars. It seems to me this is a proposal to disintegrate, dismantle European finance and make it a pure appendage of the American banking system. It's an absurd thing. It does not give me confidence in the leadership that is being offered by European institutions at this point in time. Thank you.
John, thank you very much.